Good afternoon, everyone. In today's video, I'd like to spend some more time just going through that morning note we sent to all of our Futures Volatility Box members, all to highlight this idea that, hey, if you actually spend some more time observing the markets in the first hour, there's a lot of clues that we can pick up to try and predict the kind of action we expect to see for the rest of the day. Now, with the S&P, the Dow, and the Russell, we were on our Scalper volatility models, which, to give you a reminder here, from most aggressive to least, that goes Scalper, aggressive, Doomsday aggressive, conservative, and then Doomsday conservative, right? So these are the 5 models we have at our disposal, and the Scalper works only with the indices along with the 30-year bond. So we do have the luxury of having the Scalper here, and so fine, we see that on the ES, Russell, Scalper. Now, to contrast this, however, and this is where things get a little bit interesting, the Nasdaq told us that it was on our Doomsday Conservative models. That's right here. So to give you an idea, the ES, Russell, all on this side of our aggressive volatility box model scale. The Nasdaq, on the other hand, is on the exact opposite side, the most conservative models that we can potentially see. And the last time I think we used our Doomsday Conservative models on our indices was really during that Feb-March type of volatility. That's actually when they were born, and we see that the Nasdaq again today breached this. However, this wasn't a move on the downside. This was actually a breach towards the upper edge of the volatility box, which we'll talk about when we go to the charts. Now, coming back to the idea of finding clues, the final market that I think gave us the clue was a 30-year bond in which we were on our Doomsday aggressive models. And so you'll see this continued in the note as well, where we expect more volatility in the S&P, the Dow, and the Russell. At least we expect volatility to catch up, given that in the 30-year bonds, we're on our Doomsday aggressive models, and in the Nasdaq Futures, we're on our Doomsday conservative models. It doesn't really make a whole lot of sense how our volatility regimes could be so different across these marketplaces, and so at some point, something's got to converge. And usually, more times than not, we see that the Scalper ends up not essentially containing price action, but instead we end up going to our more conservative models. Really, the idea here is just following some very simple breadcrumbs, some very simple clues. You can essentially try and position yourself for the rest of the day and not be surprised at the very least with any volatility that comes into the other markets. Just to recap here before we get to the charts, the clues that we had today, the difference in the volatility regimes between the indices here, right? ES, Russell on the Scalper compared to the Nasdaq. And then we also had our 30-year bond letting us know that we're on our Doomsday aggressive. Typically, we see that on our bonds, we're on just the aggressive models, not the Doomsday aggressive. And so already layering up one level should give you this notion that we should expect more volatility to hit the futures markets, at least the broader indices, as the day continues. Now, if we come to our charts, we'll start with the S&P futures chart first with our Scalper models, and I'll very quickly go through this. But off of the Scalper here, you should notice we saw a breach outside of the clouds. We saw volatility enter the marketplace towards the upper side. These were all short entries, but we did see that increased volatility start to catch up, right? So we see the ES. Then if we come to the Dow, on the Dow, very similar thing as well, right? And then if we come to the Russell here, the Russell slightly different, but also very similar story in that we saw a breach and then we ended up going outside of the Scalper clouds. And so all three of these should give us the idea that, hey, we expected more volatility to happen in all three of these markets. That's exactly where we saw that volatility. Now, to contrast this, if we come to the Nasdaq futures markets right here, the Nasdaq futures in that first hour is where we saw we had to go from our Scalper to our aggressive models. Then from our aggressive, we ended up breaking even outside of that cloud, right? That we were looking to essentially see price action being contained inside of this level right here in that first hour. Didn't happen. So again, our sign to switch over to our Doomsday aggressive. Again, just continued to break outside of each hour's clouds in that first hour test, where finally, even after the conservative, we breached it. And finally, the Doomsday Conservative was the only model in which we hadn't breached that first hour sign entry line test right here. And that's where we ended up on the Doomsday Conservative models. Now, finally, we'll wrap this up with the bond. So if we come to our Doomsday aggressive models here, actually, let's start with our aggressive models. We saw our aggressive models breach where we had price action go outside of the clouds here. And that happened before we got the edge signal. So again, without having capital at risk, our sign to switch over to our Doomsday aggressive models. And you'll notice off of the Doomsday aggressive models, that breach did a much better job of containing price action. When we saw price action breached our sign entry line, got the edge signal, we got the follow through before getting the opportunity to re-enter, then had a re-entry at the sign line before this was the ultimate flush move down lower. Of course, we hit that T1 right here after that edge signal, so no real opportunity to re-enter at the sign line without it being a retest, but still interesting, right? Now, as the day progresses, if we come back to the Scalper models, we saw that the volatility box really breached in that 10 to 11 a.m. Pacific hour. The thing that I thought was interesting, come back to the bonds here off of the Doomsday aggressive models. In that previous hour, before when we saw that breach, the 10 to 11 a.m. Pacific hour, we saw price action breach our volatility box sign entry lines on the 30-year bond, and we saw us break outside of that. So again, just really in layman's terms, this tells us that, hey, even the doomsday aggressive models at this point didn't hold. Now we're switching over to our conservative. So the volatility is only increasing more and more here, right? We're now switching to our conservative. And at this point, the ES is still on the scalper, right? We hadn't breached in this hour yet. We just saw price action really starting to sell off here, but still being respected. And then once we saw that increase in the bond, we also saw that same sort of volatility ensue in the S&P futures. Only difference is we saw that happen in the next hour, right? That happened in the 10 to 11 a.m. hour versus the bonds gave us the clue in the 9 to 10 a.m. Pacific hour. And so again, just clues all around. This is where if you just start to pay a little bit of attention using all of these models, the volatility box models gives you a lot of different little clues around what to expect in price action for the rest of the day, which again helps to position not only your existing trades, but things like when to take profits, things like which volatility box models you're using to try and fade, so on and so forth. All right, hope this video helps. Good luck trading the rest of this week, and we'll see you in the next update. Take care, everyone.